Well, big tech earnings and the Fed decision are the two big market drivers today. Let's talk about that and more. We want to bring in Stuart Kaiser. He's the head of U.S. equity trading strategy at Citi. And Stuart, we were debating where to start here, but let's start with big tech. Obviously very critical here to the market. In terms of what we're hearing tonight and what we hear over the next several trading days as we do get more and more results, how critical is that to the market narrative?
I mean, I think it's very important. It was going to be very important to begin with, and then obviously the DeepSeek news on Monday makes it even more important. I actually think, frankly, the results will matter. Most of the hyperscalers kind of already recently updated their guidance on CapEx spend. So a lot of this may be actually what gets said in the press conference and what is the CEO's kind of body language. How committed are they to that CapEx spend? How vital do they think that spending, and particularly the really high-end Nvidia chips, are to their development? So numbers matter for sure, but I actually think incrementally speaking, the commentary from the CEOs is going to be probably more important than it otherwise would have been.
Does the decline that we saw earlier this week and some of that selling action, does that at all change your longer-term view? I know you were very positive of large cap growth going into this year.
Yeah, we're still generally positive on it, but I think you have to be in a little bit of wait and see mode just in terms of how this is ultimately going to play itself out. So yeah, we're still positive on the space, but we're not exactly aggressive buyers here. And a lot of that has to do with positioning. You know, people are so long these stocks to begin with, and if the news over the weekend does force a little bit of a positioning rebalance, then that's going to create kind of some churn and some volatility. So we've been a little bit cautious in terms of stepping back in, but kind of, big picture, we do still like that part of the market.
What would those levels be in order for you to be more of a buyer?
Honestly, it has less to do with the price level than I think the clarity around the news. Already you've seen, Elon Musk kind of push back a little bit. Some Nvidia's kind of pushed back a little bit on the DeepSeek update. So honestly, there's just not a lot of clarity exactly on the cost, as Dan mentioned, on the efficacy. I know those models have actually performed pretty well in some of the testing, but we just don't know at this point. And that's why I do think kind of the body language from these CEOs in terms of what is their view on the medium term, has that shifted meaningfully, is going to be very important.
So the resilience that we've seen in most other parts of the markets this week, how reassuring is that to you?
It's quite reassuring. I think that you have seen a broadening out. I mean, big picture, if you said, look, AI just got cheaper and faster to develop, that's good for the economy. It's good for most stocks in the market. It's obviously very negative for a pretty small cohort of stocks that have been under a little bit of pressure. I think the most worrying thing, frankly, yesterday was the fact that utilities didn't recover as much, because utilities kind of that knock-on AI infrastructure story, and we didn't see, incremental buying in that space. So I think that's, a little bit incrementally concerning. But otherwise, look, the fact that on Monday, 2/3 of S&P stocks were up, more than half of NASDAQ stocks were up. S&P equal weight was actually up on the day. A number of sectors, utilities not being one of them, but, healthcare staples, these performed well. So all that I think was very encouraging. It wasn't just a sell everything moment. It was, this is a risk to positioning and sentiment in a key part of the market without a doubt, but it did kind of get localized in there.
If we do see maybe more sideways action or even potentially more selling within utilities, what does that signal to you?
Look, I think it does suggest that these AI adjacency sort of stories, and clearly that is a big part of the CapEx spend story, is under pressure. You might argue if you get more widely distributed AI, you're still going to need all of that power generation. But to the extent that we don't see recovery in that part, I think one of two things is happening. Either that AI CapEx spend story is kind of running out of steam a little bit, or secondarily, you just have a real big positioning issue that needs to be dealt with in that space. Power generation to us is a theme, kind of medium term, that just makes a ton of sense to invest in. But again, when you have these positioning moments, from our perspective, you just kind of step back until you have a little more information.
Stuart, how big of a deal, or maybe how major of an event, maybe it's not as big of a deal, is the Fed meeting this afternoon? And I guess the real risk, much of this is going to be around the rhetoric surrounding Paul and how dovish versus how hawkish maybe some of that sentiment's going to be.
Yeah, I think you hit it right. It's really on the rhetoric. I mean, they updated their economic projections in December. All of the data we've gotten this month, whether that's unemployment rate, inflation, et cetera, have been right in line with their expectation. The market's pricing 2 cuts, which is exactly what they forecast. So from a data perspective, there's really not a lot for them to say. So it's going to be, how are they reacting to the news from DeepSeek? How are they reacting to potential policy news and tariffs and things of that nature? You could also argue that the tariff news has been better than feared. Mm-hmm. So from their perspective, that actually removes a key point of pressure. If you had large across-the-board tariffs initiated over the last week or two, the Fed would have had to have really dealt with that directly. In this case, they can sort of say, hey, we'll wait and see.
What about the threat, though, of what could be imposed on Saturday, February 1st?
Yeah, it matters, yeah. But I think the worst case scenario was that Trump came out full bore, across the board tariffs, very aggressive on China, et cetera. And We haven't had that. Bessent's actually sort of nodded that we might get this very gradual build in. And from a Fed perspective, that's much easier for them to deal with from a policy perspective. They've been very clear, and our economists agree, they are not going to adjust their policy stance based on what could happen. Until we see the tariffs announced and implemented, they're going to kind of be in wait and see mode. And I do think the first 2 weeks of the Trump presidency has actually given them a little space to continue to do that.
If we could pull up the graphic that we just had a moment ago, and very much, I pulled it from your note, and you talked about the implied volatility or some of the market-moving events that we could see here. We narrowed it down to over the next week, or over the next month, excuse me. When we already talked about the Fed, we talked about big tech earnings, obviously, that's front and center. But what about payrolls next Friday? How big of an implied move could we potentially see as a result of that number?
Look, we think the unemployment rate is probably the single most important macro data point you're going to get every month. So the day at the beginning of January was very favorable, got that unemployment rate back below 4.1%, which was a big surprise. So next week is going to matter. I mean, if you see a significant uptick in the unemployment rate, I think that potentially puts the Fed under pressure and puts the market under pressure as well. So that's what we'll be watching. You have a lot of seasonal adjustment stuff going on this time of year. So that number has like a lot of wiggle room around it. And for that reason, I think you will see options markets pricing in a pretty good risk around that event.
What is your assessment surrounding that? Just in terms of the fact that the labor market has remained very resilient, just I guess that downside factor risk, how real is that?
Again, I think if you got, our economists believe the unemployment rate is going to move back up towards the 4.5% range by the middle of the year. That type of move, in our view, will be quite negative for equity markets. So, so far the data has been better than expected. I think the Fed, the last 12 months, has gotten data that couldn't have been better from their perspective, right? Labor market holding in, inflation coming down. I think inflation's kind of been pushed a little bit off to the side, and the focus is right now on the labor market. And to the extent, the Fed has the unemployment rate staying below 4.3%. If that happens, that is unequivocally good for equity markets. Mm-hmm. But if you do get this inflection point, it could be a challenge. A lot of folks are saying, well, we want more rate cuts, and we're sort of in the careful what you wish for category, because the data that would motivate those rate cuts would, in our view, be a weaker labor market. And I think if you're an equity investor, that should not be what you're hoping for.
All right, Stuart, always great to get your insight. Thanks so much for taking the time.